Hi, I'm Francis, investment strategist at UOB Private Bank's Chief Investment Office. Welcome to the CIO Campus, UOB Private Bank's quarterly investment viewpoints. Last quarter, global markets had a rough time as most of the risk assets consolidated, resulting in a modest sell-off. The MSCI World Index, for instance, dropped 3.3% in the third quarter, and that was following a 15% rise in the first half of this year. Meanwhile, the US Treasury 10-year yields traded above 4.7% at one point, bringing the total returns into the negative zone. This marks the third consecutive year of negative returns for US Treasuries. It was a phenomenon not seen in the past 50 years. As we now enter fourth quarter 2023 and approach 2024, what is the best strategy for investors? The key economic trend in 2023 is US exceptionalism. As the first developed economy to raise interest rates, the US has outperformed most advanced economies and averted a much-anticipated recession. Moreover, inflation remained low in the US despite a very strong labour market. For instance, core inflation came off much faster than the G20 economies this year. That said, we cannot be too quick to conclude that we are in what seems to be a sustainable Goldilocks economy. The US did not slip into a recession this year, although consumer spending has been low. The key reason is because of the strong government's expenditure. In fact, government expenditure in the US is so robust that the federal budget is experiencing a crisis-sized deficit, doubling to around $1.6 trillion in 10 months through July. Such fiscal boosts are typically associated with recession fighting, except that right now, we are not in one yet. The massive fiscal impulse coupled with Fed's interest rate hikes led bondholders to seek higher yields, causing the 10-year Treasury yields in the US to surge past 4.7% at one point. The reality is that US government debt servicing costs are soaring, reaching around 3.4% of GDP per quarter, and that is only for interest payments. The US government spends over $600 billion annually just on interest payments alone. And to have a better idea on how big that is, you can build around 120 Apple headquarters in California just with that sum of money. Looking ahead to 2024, we expect these government spending effects to diminish due to base effects, resistance from the House and Congress during debt ceiling negotiations, and also the high yields demanded by US Treasury investors. Given the potential economic slowdown, we opine that the Fed is likely to be at the end of its hiking cycle. The question now, however, is how long will the current high interest rate environment last? Although the Federal Reserve members kept warning that interest rates need to stay high to fight inflation down to the 2% target, we believe that the economic slowdown in the US could mean that although rates can stay higher for longer, it's not going to be forever. The anticipated US economic slowdown makes risk-adjusted returns appealing for the fixed income markets. From a technical perspective, we have reduced equities in the mixed asset portfolio to a slight underweight, reflecting some of the near-term challenges. However, given our expectations of the overall resilient earnings outlook and the potential for a mild recession, any sell-off is likely to be moderate. Investors may consider taking advantage of opportunities within this range-bound trading pattern. Investors should diversify with a focus on high-quality bonds, short-term money markets for attractive yields, and also private credits. In the short term, consider a non-directional participation in equities, whether through selected hedge fund strategies or structured payoffs. This approach aims to provide a return structure with positive real returns and also resilience in the face of a potential economic slowdown in 2024. That's all for today. Do look forward to our next episode of CIO's Campus, and for more insights, speak to your senior client advisor.